in terms of self-improvement, there's always something you can do. And then I suppose the benefit for me as an algo trader is that when you come across one of those things and you realize there's something that you can change to improve that, you can then implement that into all of your strategies and you can benefit from that moving forward.
Welcome back everyone to I'm sitting down with Martyn Tinsley from trading for Darwinex at the moment, a algo trader. It's going to be interesting to hear his perspective on algos. His website is called Trade Like a Machine. So Martyn, welcome on the podcast. How's it going today?
It's great. Thank you. Thank you for having me, Etienne. It's a pleasure to be here.
Yeah, good to connect with you. I've heard a lot of what you do. I've seen kind of the work you do online a little bit. But I want to kind of go back in time and tell us a bit more about how you began trading in the first place.
Sure. Okay. Well, sort of going back a long time now, I got very interested in the concepts of predictive analysis. So predicting different events. So that could be, for example, football matches. It could be even, my own rudimentary attempting weather forecasts, things like that. And anything that I could get data for, I would basically crunch the numbers and try to come up with a predictive model that would predict what would happen next. And I was doing this as a teenager. So when I was a teenager, the two sort of main computers on the market were the Spectrum 48K and the Commodore 64. And I had a Commodore 64, and that's how I learned to program. And so I was programming those models as a teenager, just really as a hobby. And I think it was those early days that eventually led to me becoming an algo trader many years later. Now, my first job as in my career was as a software developer, so that taught me again many of the skills I needed to eventually become an algo trader. And I guess in the early days, when I first started to investigate trading, I was very much trading in a manual manner. And I think many people do that even when they do become algo traders eventually, because it helps you to learn about the mechanics of trading and how trading works, how charts work. And so I learned a lot from those early days as a manual trader, but unfortunately also lost a lot of money. Because manual trading just simply was not for me. I think to be a successful manual trader, you need to have the right psychology. You need to have patience. You need to be able to look at charts and make valid decisions without emotions taking over. And for me, that was a real problem. And I struggled with that immensely. And so eventually, when I'd learned what I needed to learn, I then transferred those skills over to algo trading.
Interesting. Now, what made you want to go into trading as a software developer? Because you can make a pretty good living, like creating softwares and stuff. What made trading so appealing to you compared to that kind of previous job?
I think that it was came back to this desire to build models that could predict future events based on past historical data. And although I loved my career, and I got a lot of value from my career, it never really took me in that direction. And so trading, firstly as a hobby, gave me something where I could, use those skills, and it was something that I enjoyed doing. And so I ran, my career as in the software world with the trading as a hobby in parallel for many years. And it was only maybe 2.5, 3 years ago that I made the jump and became a full-time trader.
What made the shift of you being from having trading as a hobby, something you do kind of on the side, to then deciding you want to do it like a main thing, a full-time thing? What made that shift?
I think it was because, I was relatively successful during that time where I was trying to juggle both of those careers, if you like. But it reached the point where I felt I'd reached a plateau and with the trading. And I think I needed to dedicate that extra time if you like, to push myself on further. And because this really did become my passion, that was where I chose to go rather than continue the career in the software industry.
So how did that turn out? Did you just like from the start want to be profitable in trading? You mentioned you have some issues with psychology and the mindset around it. What was some of the biggest part to becoming a good trader overall?
So for me, almost instantly, when I transferred from being a manual trader to an algorithmic trader, that was the key moment that things began to change, because I knew the rules that I'd I'd come up with through my analysis of past data and so on. I knew they were good trading rules, but the problem I had was the lack of patience. So I knew in some instances, for example, I should wait longer before I opened a position. But because of my lack of patience, I couldn't, and I was trying to get into the position too early. And likewise, when you're in a position and you may be going to profit, I cut those profits too short because I was fearful, if you like, that I would then, the market would turn and I'd lose that, even though I knew it wasn't the right time. And so by building the rules into an algorithm and literally just letting the algorithm do the work, instantly I saw a shift in my performance. And I went from loss making to, break even pretty quickly, and then over time refined that to become profitable. So that was the key moment for me. I'm not saying that's right for everyone, but it's right for me because of my psychology, and the algos take away the issues that I had as a manual trader.
For some people who are not too experienced with algos, they might think like it's something that can not make money for the long time. That it has to lose money because it's like it says in the rule. They think that if the algo run too long, it's going to stop working. What would you tell those people who think that algo is just like a temporary thing that can make money for a while but cannot sustain this for long term?
Well, the way I look at this is that if you're a manual trader and you come up with a set of rules that you try to adhere to in order to take money out of the market, then over time, if you keep those rules constant and the same, that also might start to lose its edge as the markets begin to change and the dynamics of the markets change. And so for me, there's actually no difference. So just like you would expect a manual trader to adapt their rules and adapt the way that they approach the markets, for me as an algo trader, there's nothing different. I simply will adapt the rules. The only difference is that those rules are being run in an automated way instead of me sitting and waiting to click a buy and a sell button. So for me, there's no difference between those. And I think both approaches need to be adapted over time to cope with those dynamics that change in the markets. And they do, you'll have markets that tend to be more mean reverting at some times, and then they'll change to more momentum based dynamics. And you have to take account of that, regardless of what type of trader you are.
And how do you change those rules? Because there's a kind of sweet spot you have to find between changing it like every week all the time and then changing it like never at all. So how do you find that sweet spot of like when to change things?
For me, there are two ways. The first is what I would call sort of dynamic changes. And so I will actually build rules into the algorithms to automatically detect what type of market it is. So, is the market currently mean reverting? Is it more momentum based? And it will actually automatically tweak the rules dynamically without me touching the algorithm at all. There are some maybe longer term changes in the markets which are more subtle, which might mean that you maybe need to, come right back to the beginning, look at the rules, see if any rules need to be changed. And that type of change is something that I would maybe do every 1 or 2 years, no more frequently than that.
Now, I think a key part of also trading with algos is building the right portfolio because you can trade algos and things that are all correlated. You're going to have a lot of losses. I know this is something you're good at, and like building a good portfolio for algos and being able to kind of run things all together for having good performance. How do you kind of deal with that and set that up correctly?
Yeah, so it's a good point actually, because again, I mentioned earlier on one of the big shifts for me was transferring from a manual to an algo trader. But another huge shift was the way that I handled the portfolio of positions in the account at any time. And this is still very much a work in progress for me, but I'm already starting to see some of the benefits of that coming through. So the reason I started to investigate this in the first place was because what I noticed about my track record was that, in the long term, I had an equity curve that went up, that had steady growth over time, but at certain points I would suffer significant drawdowns. And for me, as a trader myself, that was fine. I could handle those drawdowns, and the reason for that is because obviously I knew what was happening behind the scenes. I knew that eventually my strategies would come out of those drawdowns. But when it really started to become an issue, I guess, was when I started to get investors in my strategies. So I'm a trader on the Darwinex platform, just like Atu, I think, who you interviewed a couple of weeks ago. The issue there is that, for investors, it's different. They don't know what's going through, my head, how my algorithms are working on a day-to-day basis. And so when investors see drawdowns, understandably, they start to panic. They don't like big drawdowns. And so I realized I had to do something about this. So when I went back and I started to look at when those drawdowns were occurring, it was at times when the different assets and asset classes in the market tended to exhibit high levels of correlation. And so what was happening is that my strategies would have open positions, but because there was a lot of correlation in the market, when the market turned against me, that caused a big drawdown. And so that really piqued my interest in terms of trying to investigate how I could put together a diversified portfolio, which is really, really important. Diversification is so important, but also pay attention to when the markets do become correlated, and take action when they do, in the form of putting together a more balanced portfolio and thinking about things like risk of the portfolio as a whole and the return of the portfolio as a whole. So up until that point, I'd done, I think, what probably most traders do, and I'd thought about risk on a position by position basis. So, for example, I'd have a rule that said, I will risk a maximum of 0.5% of my account on each position, or 0.25%, or whatever it is for an individual's risk appetite. And everything was done on that basis of controlling risk on a single position and doing that for each of the positions. But what I realized was that actually there's a huge amount of benefit in thinking about risk completely differently and thinking about it on a portfolio basis, and also the return on a portfolio basis. And when you do that, you're then able to position size each of your positions to maximize the return over the risk ratio on that portfolio basis. So what I've got here is an equity curve that shows that individual position risk management that I talked about a moment ago. And as you can see in the first half of this, performance is very good, but then performance starts to flatten out, and there's some pretty serious drawdowns, especially this one at the end here. So let me just explain the different colors here behind the lines. So obviously the blue is the equity curve. The orange line here represents the high watermark. And then the gray line, I've set that here at a 10% drawdown from that high watermark. So you can sort of see what the kind of drawdowns are here. And pretty much up until the end here, the drawdowns are staying, broadly speaking, within that 10% region. But then here at the end, the drawdown exceeds that and probably goes to something in the region of 30%, which, for investors is a big issue. When I transferred the risk management of this over to the portfolio basis, this is what happens. So bear in mind here that all of the trades are absolutely identical from these two charts. So the trade entries are the same, the trade exits are the same. The only difference here is the position sizing and the relative position sizing between the different positions that are open in the portfolio at any point in time. And so there's a fairly, dramatic reduction here in those drawdowns, because what's happening now is that when the algorithms recognize that the markets are very correlated and the positions that are being held at any point in time are correlated themselves, it dramatically reduces the position sizes at those times. And then at other times, when the portfolio is much more diversified and potentially negatively correlated between some of the positions there, then it then increases the position sizing in relation to what it would have done previously. And so this is the kind of effects that I've realized you can get from that. So, a massive improvement. So I think I've got here this is sort of a side-by-side comparison. So the orange line here is what you have with individual position sizing, and then the blue line with portfolio position sizing. And interestingly, you can see that, early on, when there weren't particularly any major drawdowns and the markets weren't that correlated, the performance is actually very similar. It's comparable. But where this tends to really come into its own is in those times when markets are correlated, and that's when you see the difference in the equity curve. And this is exactly what I set out to achieve. Now, this is, as I said, this is still a work in progress for me. I've still got things I need to investigate here. So I've started to implement this in some of my strategies. Still got, I guess, fairly long way to go, but I think with trading, that's always the case. There's always things that you can improve. There's always new things that you can learn. And so, I realize that over time I'll hone this and make it better and better. But that's the sort of effect that I'm looking at now. So hopefully, I'll start to see much smaller drawdowns in the equity curve going forward.
That's a really good example of problem solving. As traders, we take trades, we get some feedback, but then we have like issues coming up. Then it's our job to deal with those issues, find ways to do things better. That's a really good example of like how you've been able to do that. Look at what works well, what doesn't go well, and then try to fix it in any way you can. That's a really good example. What kind of indicator or factor do you look at when you say the market are correlated? Is it just based on how price moves together, or do you have some other kind of indicators you look at for this?
Yeah, so it's purely correlation calculation. So interestingly, what I did from my analysis of this, I went through many stages, I guess, of attempting to produce these kind of improvements in the equity curve. And initially, I went down several dead ends, ended up with equity curves that didn't really achieve what I was after. And ultimately, in the end, I actually turned my attention to some of the techniques that are used in much longer term investment houses in terms of concepts like the efficient frontier. So these are concepts that are used from modern portfolio theory that are designed for much longer term holding of assets, and putting together and constructing a portfolio that maximizes that return over risk. And so when I sort of read and investigated these techniques, my first question to myself was, well, can these techniques be transferred to a much shorter term trading type environment? And so I started to, read about the financial risk management techniques, get hold of any research papers that I could that talked about modern portfolio theory, and looked at adapting those to a much shorter term time frame. So if I just show you again some of the sort of the concepts around that. So this is what's called a minimal variance frontier. And along the x-axis here, you've got risk as measured by portfolio standard deviation. You don't have to use standard deviation, but it's probably one of the most common ways of doing this. And then on the y-axis, we've got the sort of expected return. And when you crunch the numbers and you look at the correlation and you look at the return and risk, this is what it actually looks like if you plot that. Okay. So the point from this end of the chart here upwards is what's called the efficient frontier. And this is where you should be aiming to get your position sizing relative to each other to get you onto this efficient frontier. Now, it's quite a complex subject and it takes a bit of getting your head around. But once you understand it, you start to understand the real value of position sizing in order to get onto that efficient frontier. Now, this part of the curve down here, I don't really know if this has got a name, but I call it the inefficient frontier. And when you're down here with your position sizing, what happens is that if you think about it, the reason it's inefficient is because you've got 2 points over each other here that have the same level of risk. Okay. But the difference is that one has a much lower expected return than the one at the top. That's why this is called the efficient frontier and why I call the lower part the inefficient frontier. Now, there's way too much, I guess, to explain if people aren't familiar with the efficient frontier already. But, I interestingly, I have put together a series of videos that explain this. I think there's in the region of about 30 episodes that explain the concepts of portfolio management. So I'd be happy to share a link with you, Etienne, if you think it would be worth putting that into the description of this podcast. But that's the whole basis that I now take in order to produce, if you like, an optimal portfolio with the right position sizes to achieve the maximum return over risk. And so obviously it's a very, very different concept than just looking at risk on a single position basis, where you say 0.5% risk per position. So it's a whole mind shift that's required to do this. But I think the results I showed you a moment ago sort of speak for themselves in terms of the value of this if you can get your head around it.
Yeah, we'll definitely add a link below in the description for people to check it out for sure. That's interesting.
Thank you.
Now, this kind of curve, is it going to be the same for every strategy or like a similar curve, or does it depend on the strategy, the kind of trade you take and everything of the sort?
The only thing I guess that informs, you always get this shape of curve, but obviously different strategies would have different levels of expected return. They'd have different levels of standard deviation and risk associated to them. And so the exact values on the curve would be different, but the shape of the curve is always, as you see the one on the chart here.
Interesting. Then how can the same risk per trade give you different returns?
As you adjust the weightings of the positions in a portfolio, obviously the overall portfolio risk changes and the expected return changes. Now, in terms of the dynamics of how this curve evolves, yeah, I must admit I don't really know. But when you run the numbers through, this is the shape of the curve you get. I think the reason for this is that if you are too heavily invested in one particular position and all of your risk, if you like, is being driven by that one position, and the other position has a very small size, that doesn't really drive the risk as much. And so what happens is that if the market turns against that position, you're not getting the benefits of diversification because the position on the other asset is so small. And vice versa. If you had all of the weighting in the second position, then equally that would mean, if the market turned against that, you don't get that level of diversification. And so by getting the right blend means you optimize the diversification to minimize that risk for a set level of return. And I think that's what drives the shape of the curve that you see here. Interestingly, this is an example just for two positions. If you have three positions or more, then instead of getting a simple curve, you get a surface. Okay, so you get this efficient frontier surface that, if you look at this, it appears to sort of bend round towards you, and so you're looking for the optimal place on that surface with more than two positions. But the concepts are exactly the same. It's about maximizing that return over risk for the surface in this case.
Very interesting stuff for sure. That's something I know most traders don't do. Even algo traders don't do it. It only makes sense to do this if you trade algos, really, because otherwise it's too hard and it will take a long time to gather the data. But I think it's something that can be worth doing to kind of understand your data better and also optimize the portfolio better. It's not just about like trading for yourself, especially with investors, something you have to think about where how you're gonna maximize the value for the investor as well.
Yeah, so this as I said, these sort of techniques tend to be used in institutional investing, and where a portfolio might be held for 6 months. And so there, I guess they can be done in a more manual way. But for me, where my portfolio changes on on an hourly basis as different trades are closing and opening, then I have to reevaluate this as every trade opens and closes. And so the only way of doing that for me is in an automated way. Sure.
Now, tell us a bit more about kind of what you trade with the algo. Is it more a reversal system? What are some things you look at with this kind of algo?
In terms of I guess the types of strategies that I develop, I'll develop absolutely anything that I think has an edge that can be programmed. And I'm a pretty firm believer actually in that anything, if you're a good enough developer, you can code pretty much anything. And if you can't code something, you could probably use AI in order to do it as an alternative way, which again is something that is on my to-do list and I'm going to be looking at in the years to come. So anything really, I think that you can get an edge from the markets, I will attempt to develop systems for. But pretty much, I'm looking at things like very simple techniques, mean reversion type techniques. So is the market currently oversold? Is the market currently overbought? And taking counter trades in relation to that. Also, I have strategies which are trend following strategies, trend continuation strategies. So, looking for existing established trends that are currently in a pullback from that and looking to get into a continuation of that. Breakout strategies. So really any of, I would say I don't specialize in any type of strategy. And I think there are benefits in that because in terms of diversification, you can diversify across assets. Obviously, we've just been talking about that, but also you can diversify across timeframes, but you can also diversify across strategy types. And so very often when mean reversion strategies are performing well in the market, trend following strategies probably won't be. And vice versa. At other times, trend following is what's bringing in the profits. Whereas with mean reversion strategies, they might be losing at that time. And so by trading different types of strategy in the same account can actually help again to smooth out the equity curve and to diversify in a different way in order to achieve a better return over risk.
What's the sweet spot though? Because you could have like 1,000 strategies if you wish, but that might be too much to manage, or you could have like 50 or something. How many strategies do you think someone should have to get a decent kind of amount of return, decent like diversification, but not be too overwhelmed by all these strategies running at the same time?
I think, when you're starting out, you start out with one. You get one strategy that you can make a profit with over the long term, and you focus on that, and you get that strategy working as well as you possibly can. And then, you then maybe think, okay, so if that's a trend following strategy, my next strategy that I'm going to look at maybe should be something like a mean reversion strategy, where I'm looking for overbought, oversold conditions. And then combine, when you've got that strategy right, combine them together into an account to get some of the benefits of that. So what's right and what's wrong? Well, if you're a manual trader, I would say the number is going to be fairly small, because if you're doing your analysis on charts, there's only so much you're going to be able to do. As an algo trader, you can probably trade more different strategies, because once you have that strategy up and running, it pretty much looks after itself. However, even when you're an algo trader, there are still limits here. You still have to monitor to make sure everything's working as it should be. You've got to monitor for any errors that are raised in the platform. You just, in terms of simple things like managing your infrastructure, you're going to need more infrastructure the more strategies that you have to be able to. Some of these strategies take a lot of processing power, especially when you're doing things like efficient frontier calculations. And so there are limits, I think, even when you're an algo trader. So although I said to you, I broadly speaking, I will trade maybe 4 or 5 different styles of trading strategy, I still probably only have about 6 strategies now that I'm trading live. And I would increase that, but yeah, there are limits, I think. But for me, 5 or 6 strategies, I would say, in terms of what I'm trading at the moment.
What's the kind of work you do on a daily basis? Because some people might think, oh, you just let it run, then you're good. You can go out, enjoy the beach, go out if you want. So what's the kind of amount of work you put in, and what kind of tasks do you focus on? And what kind of tasks are just like fully automated with the algo?
So I think when you're a trader, there's always something else that you can learn. You can, in terms of self-improvement, there's always something you can do. And then I suppose the benefit for me as an algo trader is that when you come across one of those things and you realize there's something that you can change to improve that, you can then implement that into all of your strategies, and you can benefit from that moving forward. So for me, no, it's there's no beaches involved, and it's pretty much a full working day. I work some weekends as well. And so, as an example, for the last 18 months, my primary project has been this one that we talked about initially, which is that portfolio management side of things. And for the first 9 months of that, I just hit dead end after dead end and didn't really progress. And it was only in the most recent 9 months that I've started to see some of the benefits. And I think I've really cracked that portfolio management side of things. But there's still a way to go. There's still ways that I can improve that. If you looked at my to-do list, you'd have a heart attack. I've probably got about 200 things on there at the moment of things that I want to investigate in the future. I alluded to one earlier on, which was artificial intelligence. And although I have coded in my career in the past, I've coded neural networks and similar kinds of AI technology. I've never actually got to the point yet of incorporating that into my trading. So that's probably in about a year's time I might start to look at that. But no, the to-do list is fairly significant, and there's lots of room for improvement, I think.
That's a good thing. Now, we got to talk about the fact that you are funded by Darwinex. So you created your own fund on Darwinex where people can actually fund your trading. How did that go? How did that kind of progress?
Yeah, so I think I was actually one of the first traders to go onto the Darwinex platform. I think I was trading number 7 or 8 or something like that. And when I came across Darwinex, it was perfect timing, really, because I'd got to the point where I'd become profitable. I'd started to build a track record, and I started to think about it. Well, how do I take this to the next level now? So I've got my own capital, which was relatively limited at the time. And I was thinking, if I can make 15, 20% year on year with the capital I've got, that really isn't going to enable me to become a full-time trader in the future. It isn't going to enable me to, I guess, exploit the skills that I'd built up in an effective way. And so when I found out about Darwinex and their concept of, traders can effectively just do what they do normally. They just trade in the way that they always trade. And if they can demonstrate a good track record, those traders will get investment. And investors rather on the Darwinex platform can see all of the traders' track records on there. They can choose themselves how to build their own diversified portfolio of different traders' strategies. And for me, this was the one of the key moments in terms of, again, taking trading to the next level, because when you get investors, obviously, you have to make profit for those investors, but you can then also charge success fees, and the success fees that you get can far outweigh the individual profits you can make on your own capital. And so it really gives traders that sort of opportunity to, for want of a better term, to manage their own hedge fund in a really low cost, effective way. So if I were to start my own hedge fund, that would carry significant costs. I'd have to think about regulation, when we're going to be regulated. And the initial costs would be significant and inhibitive, I think, for a lot of traders. And so with Darwinex, that's, I guess, all taken care of. So, they have the regulation covered so that traders on the platform are covered without having to deal with any of that themselves. So it was a great opportunity for me when Darwinex came along. And I'm sure, many of your viewers might consider it as well, because it's that really, I was going to say low cost, but in fact, I think it's no cost. You can sign up for a free account and just start trading. And if your track record is good enough, you can get investment. And if, for traders that have already built up a track record, I believe they can actually migrate that into the platform, so you're not starting from scratch.
How long of a track record do you need for Darwinex? Is it like 6 months, a year, or more than that?
It's a long time since I was in that position, but it's all based on, so Darwinex has these things called investable attributes, which are they are metrics that measure, if you like, the effectiveness of your strategy. And one of those metrics is called experience. And that just basically measures, how much track record do you have? How much trading activity have you had? And you have to get your experience to a certain level before you can then open up your strategy for investment. But, so that very much depends, I think, on how frequently you trade. So if you only trade very infrequently and you might only have one trade a week, it would take you longer to build up that track record in order to make it available to investors. If you're trading like I do, maybe 20, 40 positions every week, you'll build that track record up very quickly. And, within possibly a matter of weeks, you could be in a position where you could be opening up that strategy for investment. If that's what you choose to do, you don't have to. You can just trade with Darwinex as a regular broker. You don't have to open up your strategy for investment. But if you want to, that's your choice. You can do that. So it all depends on how much track record you have. Obviously, if you're importing a track record, then it might be that you can, make your system available for investors immediately if you built up enough track record with an alternative broker. So it all depends, but yeah, relatively quickly, I think. But of course, getting investors, I guess, is a different matter. But I've seen many strategies on the platform that have got a good, solid track record over, let's say, 6 months, and even they can start to get some level of investment. And then as time goes on and the track record increases, that investment will grow over time.
How do you feel like the pressure increases once you start to manage more and more capital? Do you feel like you're more pressured? You have to kind of deal with your mindset a little bit more than before, or how did that kind of evolve?
Yeah, it's definitely different. I mentioned before that some of the drawdowns that I've experienced in the past, I was probably quite comfortable with those. They weren't necessarily a problem for me. I knew that the reason for the drawdowns, I knew it was because of the correlation and things like that that were causing them, and I knew that would end and the strategy would become profitable again. But when you get investors, you've always got to put yourself in their shoes and sort of say, well, what's an investor thinking now? And from an investor, they don't have that assurance of why is this drawdown occurring? And so, yes, it does need a mind shift. And you're responsible for investors' capital and the growth behind that. So a very definite shift. As an algo trader, I think it's less so, because as long as you have the commitment to just let your algorithms do what they do, you're not going to start making any crazy decisions. If you're a manual trader and you notice a trade going against you, I guess the temptation is to change your behavior because you know that investors are being affected, whereas you might just let that carry on and hopefully recover if you were only trading your own capital. There is that mind shift, and so you have to be able to cope with that. And my way of coping it was doing exactly what I said to you before. Over the last 18 months, I've been looking at how I can reduce those drawdowns for investors by looking at those, modern portfolio theory techniques and adapting those to trading. So that was my response to it. But different traders will have different responses. But yes, it is different, and the psychology is different for sure.
Interesting. Definitely a learning curve you have to go through at first, and you got to be able to get used to it. But if you can get used to not touching your algos, not changing your risk, then it's for sure better.
The journey is important. So the scenario I mentioned to you a moment ago, you might start getting a small amount of investment after 6 months. And when it's only a small amount of investment, that's something that you can probably handle. If all of a sudden you had $10 million of investment, that would be very scary. So if you went from nothing to 10 million, I know Atu, who you spoke to a couple of weeks ago, he's currently managing 10 million, but he didn't go straight to that. He went, he gradually built up that investment over time. And so I think because of that enables you to handle it more effectively. So, if you start off, you might start off with $1,000 of investment, and that you can handle, it's fine. And then it will gradually grow and you acclimatize to that, which helps, rather than just going in big bang. So I think that's a good side of the Darwinex platform, that you will see growth gradually over time.
Definitely a good point there for sure. So what can people find you if they connect with you or reach out after the interview here, if they want to see your work or see what you're doing?
So my website is tradelikeamachine.com. I also produce, didn't do from the beginning, but now I produce a lot of videos for Darwinex as well. And so people can hook up with me through the Darwinex channel. I'll look at all the comments on the videos there. So there's a number of ways people can get in touch if they need to.
Yeah, definitely an interesting journey. So I hope we can connect in the future, see how you're doing with the algos. I'm kind of on that journey too with the algos as well. So definitely a fun game to learn. It takes time, but I'm getting there slowly, so that's good. And yeah, let's see how you perform over time, and we can connect back and see how you're doing in the future.
Yeah, it's been a real pleasure, Etienne. Thank you very much for having me, and I hope some of that was useful to your viewers. So until next time.
Let us know in the comments below in the comment section. Tell us if you like this interview. A bit more in depth than before, but I think that's useful sometimes. It's worth it to go more in depth on these topics. It's that you can learn much more perspective, how other people do things. Good to grow, of course. Good to become better. So I appreciate that.